Hello, my name's Craig Earlham, Senior Market Analyst at Oanda. Today we're going to talk about the S&P 500. We've seen a lot of action in the indices over the last couple of weeks. 1 second we're making record highs. Earnings season is going better than we were expecting, potentially even going to avoid a season of negative earnings growth. Now, given that we were previously anticipating a potential earnings recession in the first half of the year, that's quite a move, and we were expecting quite a sharp reduction in growth, in earnings growth as well. So now it seems that we're now potentially going to actually see some positive growth here. So that's one of the things that's really helped to spur these indices back to these record high levels. Of course, this week that has taken a turn. We've seen from Donald Trump, Trump's Twitter over the weekend, suggesting that these talks with China are now not going as well as hoped. We have to remember that only a week ago it was being suggested that we may get a deal as early as this Friday. And now we've got Trump suggesting that actually there's been a breakdown in talk, backtracking on the part of the Chinese officials, and now this Friday we can actually see more tariffs imposed. The previous bunch of 10% tariffs being increased to 25%, and potentially more tariffs to come now on the remaining $300 billion or so of imports. This is a massive development here. Now, it could, of course, just be all talk. It could just be that last attempt to put more pressure on the Chinese in order to try and get them to back down on certain issues. But at the moment, this is something that has to be taken seriously. We have to remember in the back end of last year, this was a major contributor to the market losing confidence and for that downturn happening. Perhaps now the Trump administration thinks they've got a little bit of extra time and a little bit of extra leverage because the markets have recovered and moved back to those record levels. But what we've seen over the course of this week is that investors are not happy with more tariffs, with more trade war, and with this situation deteriorating. So now we find ourselves back at a really interesting level in the S&P 500. We've come back towards these kind of 2860 levels. Now, that may not sound like a major level. Usually these major levels can be more the round numbers, the 2800s, the 2900s. But this 2860 is actually really interesting. We're at the bottom of that rising channel, which we've been trading in now for some time. We've tested the upper and lower bounds of that on a few occasions. So this is quite a fixture now on this chart, and we're now testing the bottom of that. The fact that that coincides with the most recent peak prior to the record is also, I think, quite interesting. When these two levels typically coincide, it just does add that little bit of extra. We've also just run into support around this level as well, so we've bounced off this level once already, which again suggests this is a level that the market is paying attention to. Ultimately, though, a lot of this depends on what the risk appetite is going to be in the markets, whether this level breaks. At the moment, we're seeing plenty of risk aversion in the markets, and I think Friday, this deadline, is now going to be really crucial, something that traders are going to be very much paying close attention to. If we do rebound higher off this level, risk appetite returns, maybe we get an extension or a deal here, then I think we could quite easily be looking back towards those previous highs where we were trading before this all happened, and we could start to see that sense of euphoria potentially even returning. So around those kind of 2950 levels will be the next levels above here, which we'll be very interested in. Below here, if we see that 2860 break, then 2800 is a clear level here for us to be paying attention to. This is a long-term area of support and resistance, so it's naturally a level that we're keen to keep an eye on. You can also see the moving averages coming into play here. That could potentially have a role to play as well. But 28 being a round number, having historical significance, does make this one stand out for me. Of course, that all depends on the break of that 2860, which is currently, at this moment in time, given the risk aversion, looking very vulnerable.